Monetary policy plays a crucial role in the economy, primarily through the actions of central banks. These institutions, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, are tasked with maintaining economic stability. One of their central objectives is to control inflation, which is the rate at which prices for goods and services rise. By influencing interest rates and regulating the money supply, central banks can either stimulate economic growth or restrain it depending on the inflationary environment. Central banks utilize various tools to manage the money supply effectively. One of the primary tools is adjusting the policy interest rate, known as the federal funds rate in the U.S. When inflation is rising above desirable levels, a central bank may increase interest rates. Higher rates generally lead to cheaper borrowing costs and encourage saving over spending, reducing overall demand in the economy. Conversely, when inflation is too low, a central bank may lower interest rates to encourage borrowing and spending, which can help in achieving a targeted inflation rate. Another important aspect of monetary policy is open market operations. This involves buying or selling government securities to influence the amount of money circulating in the economy. When a central bank buys securities, it injects money into the economy, increasing the money supply and potentially stimulating inflation. On the other hand, selling securities withdraws money from circulation, thereby tightening the money supply and helping to control rising prices. This tool is vital for adjusting the liquidity in the financial system. Inflation targeting has become a common strategy for many central banks around the world. By publicly announcing specific inflation targets, these banks aim to set expectations for businesses and consumers. When people believe that inflation will be stable and predictable, they are more likely to make long-term economic decisions, which can stabilize the economy further. However, achieving and maintaining inflation targets can be challenging, especially during periods of economic uncertainty or external shocks like oil price surges or financial crises. In conclusion, central banks have a profound influence on managing inflation and the overall money supply. Through tools such as interest rates and open market operations, they strive to create an environment conducive to economic growth while keeping inflation in check. The balance they must strike is delicate, as missteps can lead to either rampant inflation or deflation, both of which can have detrimental effects on the economy. Understanding the mechanisms behind monetary policy is essential for grasping how economies operate and how our daily lives are impacted by the decisions made at the central bank level.